Good morning, it's Mike Lynch with AmeriFirst Financial, and it is time for your Monday morning mortgage update for the week of June the 7th. Hope everybody had a great weekend. We had a great weekend, wonderful weather, spent some time on the lake, but let's talk about what's happening in the market. So last week, we saw rates really unchanged. They ended the week the same way they started, and we've seen this for about the past 3 weeks. Definitely some volatility in those 3 weeks, but really not much change to the rates. So what are we looking at this week? 3 things: inflation, Fed taper, and economic reports. So let's talk about inflation. I've been talking about this for months. We know that inflation is going up. Everything's more expensive to buy, and that inflation has been expected to increase into the summer and maybe taper off after the summer. Why is inflation an issue with mortgage rates? Because let's look at it this way. If you have $1 million in bonds and you're getting a 4% rate of return, but inflation is 1%, right? You're guaranteed 4 on the bond, inflation is 1, you're really getting a 3% rate of return. If you have that $1 million bond at 4%, and now inflation is 3%, you're only getting a 1% rate of return, right? You're getting less back. So they're going to raise the yield on those bonds, which is in essence a rate maybe to 7% or to 6%, so you still get your 3% back. That's inflation. That's why inflation is bad for rates, because when they raise the yield on the bonds, in essence, that's a rate, and that causes rates to go up. So inflation, we know, is getting worse. Supply chain inflation, transportation inflation, raw material inflation, food inflation. It's just more expensive to buy stuff. It's more expensive to fill your car up with gas. It's more expensive to buy wood. It's more expensive to buy bread and milk. And it's not getting any better. Now we're going to have to start dealing with debt inflation. All the debt that we put into this economy since the pandemic started, we're going to have to pay this back. So why are rates not higher? If we're seeing this increased inflation, and inflation is supposed to be the death of rates, why aren't we seeing rates going up? They're still fantastic, because the Fed keeps stating that they're going to artificially buy mortgage-backed securities, keep buying mortgage-backed securities to keep those rates artificially low. And they've been buying mortgage-backed securities since the pandemic started. So think about it this way. Interest rates are traded in the MBS market, the mortgage-backed securities market, which is in the bond market. And if the Fed keeps buying those mortgage-backed securities, that's going to drive those mortgage rates down. When they pull out and stop buying them, the free market has to buy those mortgage-backed securities, and there's an indication that those rates are going to go up because the Fed's been pumping so much money into the bond market. So some reports this week are going to show inflation going up. We'll talk about that in a second. Also over the weekend, Janet Yellen, the ex-Fed chairman, said that, hey, slight increase to mortgage rates, slight increase to rates in general is not a bad thing. So is that going to move the market? Are people going to listen to Janet even though she's not in charge anymore? The real question is, when will the Fed start to taper? When will they start to buy less mortgage-backed securities? And that's our second thing. So buying less mortgage-backed securities is going to drive those rates up. Less money going into the mortgage-backed securities market is going to drive rates up. And we want this to happen. We want the free market to really determine where mortgage rates are, but we don't want the Fed to just do this overnight, stop buying mortgage-backed securities, and those rates skyrocket up. And they're not going to do that. So they talk about this thing called taper. And that means that they're going to slowly stop buying mortgage-backed securities and let the market determine those mortgage rates. Maybe the end of the year, first part of 2023 is kind of what people are starting to talk about. They haven't really wanted to talk about this for a while because they didn't want anybody to panic, but it looks like it's going to happen. It has to happen. We can't keep these rates low forever. If inflation is coming, if a recession is coming, which it's going to happen, one of the prime ways that the Fed controls inflation is by lowering the prime lending rate. Well, they can't lower it if it's already as low as it's ever going to be. So they got to raise the rates to prepare for a recession that most likely is going to come in the future. So the third thing is economic reports. Thursday's a big day. We got Treasury bond auctions. Basically, the Fed sells treasuries to raise money. And if there's a big appetite to buy those treasuries, that's actually good for rates. It'll push rates down. If there's a weak demand for those Treasury bond auctions, it could move rates up. Also, we have the CPI report, Consumer Price Index, which is a big indication of inflation. That's coming out Thursday. If that's up, we could see rates go up. And then weekly jobless claims. So we expected a lot more jobs to be added to the economy last week. It was not added. The market expected 1 million. There was like 500,000 jobs added. So it was a missed mark. And does that mean we're going to see more people filing for unemployment this week? Time will tell. So really, Thursday's a big day. Not much that's going to move the market into Thursday. We expect a light week into Thursday, and we're floating rates into Thursday. So if your clients need any insight on mortgage rates, go ahead and give me a call. All my information is down below. If you know somebody could benefit from this video, please forward it to them. If you have any comments, I'd love to hear them. Have a great week, and we'll talk to you soon. Bye-bye.